Yo, what's going on, guys? It's Evan Trades, and I'm back with another video on ICT concepts, another educational video. And in today's video, I'm going to be going over liquidity and what is liquidity. I'm going to be answering that question for the beginners and how can you use it to your advantage in ICT concepts and why it's so important. And before we start the video today, I just want to point this out that I am not a financial advisor. I'm not a licensed financial advisor at all. Uh, this is just my opinion on the markets. I have well over a year in experience in the markets, and I'm here just to teach beginners who are just getting started in ICT concepts. So, before we get into explaining what liquidity is, I want to explain what swing highs are and swing lows because that is crucial before we get into that, and I don't want you guys to be confused. So, what is a swing high? And I'll be sure to show you guys examples too. But what is a swing high? So, a swing high is formed when there's a high with a lower high to the left and the right, and a swing low is formed when there's a low with a higher low to the left and the right. So, let's get an example with the swing high, and I'll show you guys what that means. So, right here is a perfect example of a swing high. So we have these three candles right here. Let me mark this out so it's easier for you guys to see. So we have these three candles right here. And like I said with the swing highs, a swing high is formed when there is a high with a lower high to the left and right. So there's a lower high to the left and the right of this middle candle. And in that case, it makes a high and it makes this candle stand out right here. Right there. All right, let's move on to the next example. Right here is another great example. So we have this high. We have this candle, we have this candle, and we have this candle. There's three candles. A high with a lower high to the left and a high with a lower high to the right. And because there's two lower highs on the left and the right, it makes this candle have a obvious high right here. Makes it stand out more, I guess you could say. Like that. And I'll draw it out just for anyone who's having trouble seeing it for their own eyes. That three candle pattern right here, 1, 2, and 3. This middle candle is standing out in between these three and makes a swing high. Now let's find one more example and then we can get into the swing lows real quick. So right here, we have this candle right here, this candle right here, and this candle right here. There's three candles. Okay, I'll draw it out for you guys. Or let me shoot. There we go. Okay, you have the three candle pattern right here. Okay, there's a high with a lower high to the left and the right. And so because we have these candles that are lower than this middle one, it creates this candle to stand out more and be higher than these two, and that's what we call a swing high. Right there. So because these two candles are lower than this middle candle, that is what causes us to make a swing high. Right there. So that is what it looks like without the gray box, just so you guys can kind of train your eye a little bit, get used to it. Make sure you back test this in the market also. so you can train your eye to see it. Now, swing low. It's quite the opposite. It's simple. It's literally just the opposite. But so let's see if we can find just a good example for you guys. We'll just do right. This is a good example right here. Or this is a good example right here, actually. So, got the 3 candle pattern right here. 1, 2, 3. And a swing low again is formed when there is a low with a higher low to the left and the right. So these 2 candles are the higher. Oh wait, my mistake. I meant to put the box right here, not on this one. Don't pay attention to this one. Pay attention to these 3. I apologize. So the 3 candle pattern right here. 1, 2, 3. Okay. Swing low is formed when there's a low with a higher low to the left and the right. So we have a low with the higher low to the left and the right, and it makes this middle one stand out more. Makes it stand out lower, which creates it as a, take a guess, swing low. Alright, and so that's what it looks like without the gray box. Price is coming down, creates a swing. Imagine like on the playground when you were a kid, you're swinging, you're creating that curvature in the air. I can't explain it. I can't explain it because I don't have a camera, but just imagine that curvature in the air you're making whenever you're on the swing. It's like a U motion. When you're going back and forth, like a swing, right? So imagine that with the market. You're making swings. You're making that U motion. You know what I mean? Let me see if I can. Maybe it'd be better if I draw it out. Well, I'm sure you guys know what I'm talking about. I trust you guys. But yeah, I trust you guys. But yeah, just imagine you're on swing and you're swinging. You're creating that U motion, that swing motion. It's the same thing with the market. That swing low. You're creating that swing low, that U motion right there. Right? Same thing with the swing high. It's just the opposite. You're creating that swing high. You're making that. Now you're making that end motion with the swing high. Right? And hopefully, I just pulled that example out of my butt. But hopefully, that kind of helped you guys a little bit. You're creating that curvature motion, that swing motion, right? And that's why it's called a swing low or swing high. It's a curvature movement in the market. So let's try to find another example with swing lows. All right, so we got right here, got an obvious swing low right here. So what do we have right here? We have a swing low. Shocker. So we have the 3 candle pattern. 1, 2, 3. We got a low with a higher low to the left and the right. And in the middle candle right here, we have the candle that stands out. And most of the time it's the wick that's going to be standing out. All the time it's the wick, actually, as a matter of fact. The wick is what's going to be standing out, that stands out between the 2 candles. And that's what creates the swing low. Right, just like that. I'm going to take it off the gray box just so you guys can look at it. Imagine that swinging motion, that curvature motion, that swing low in the market, and they're everywhere right here. Even this little, curvature right here, right there. And right here would be the swing low. That would be your guys' swing low right there. Because this 3 candle pattern right here. 1, 2, 3, and in this 3 candles, this, you have the low with the higher low to the left and the low with the higher low to the right, and this middle candle, its wick is standing out in the middle of it, and you mark it out right here, and that is your swing low. That curvature motion, remember that, guys, that curvature motion, like a swing on the playground set, and imagine that in the market, creating that swing, creating that. All right, let's do one more example, and then I'm going to explain why liquidity is important in ICT concepts and what exactly it is. So let's do this one right here. Perfect, perfect, perfect. So just go over it real quick. You got this candle right here, this 3 candles right here. 1, 2, 3. Got a low with the higher low to the left and a low with the higher low to the right, and this middle candle right here, its wick is standing out, sticking out more in between these 2 right here. And what's that doing? Creates a swing low, just like that. So that is what swing highs and swing lows are. That's how you can identify them. I recommend going back testing that as much as possible, just so you can train your eye to go see that in the market in live time. So now I'm going to be going over what is liquidity. Well, liquidity is essentially where retail traders have their buy stops or sell stops. So for example, let me go back into replay mode and I'll show you guys an example. So actually, you know what? So retail traders, what do I mean by retail traders? By retail traders, I mean by whenever they see the market going up, that's when they buy. They're momentum traders. So in a retail trader's mindset, they see the market going up, that's when they buy, catching the trend, catching the momentum as much as they can, and they set their stop losses below these swing lows right here, thinking it's going to get protected by price. So as a retail trader, they'll enter like around here. Well, actually, they'll do it right here. They'll see this momentum up, and they'll try to catch this big, 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 big move. Try to catch as much as they can. So they'll enter right here. They'll try to go as far as they can, and then they'll put their stop loss below this low. So let's pretend this red line's the stop loss. All right. And then let's let price play out. And what does price do? Breakout traders see this. They see price break above this level and they think, oh, it's a breakout, it's going to go to the moon. No, 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 no. Price is seeking those stop losses. So in this case, this swing low would be sell side liquidity. In ICT concepts, that's what it would be. And in reality, it's retail traders who caught this, who are trying to catch out this big trade. Their stop losses are below here, and price is hunting that. It's targeting that, trying to take out all that liquidity. So, and it's the same thing with buy side liquidity too. Whenever price, so for actually, let me just show you guys an example. So, here is a great example right here. So we have this huge dump off in the market. We see a little retracement, and we see momentum going back down. And retail traders, they think, oh, there's a big candle, there's a big red candle going down. I'm gonna go short. So what do? They go short. They put their stop loss above this swing high, right here, or whatever, somewhere around there. And then they're just targeting, you know, these huge profits, or, you know, huge ranges to try to make up for their stop losses, or, you know, huge. They're trying to catch these huge trades, you know, and they're risking a lot of money. And the market, like I just said, it seeks that liquidity. It seeks those stop losses because there's money behind that. And with these banks or these big institutions that are trying to put in orders in the market, they need to liquidate those stop losses. They need to take those out to fill their big orders, because they can't just put out and press buy and then all of a sudden their 1 million contracts are in the market. That's not how that works. They have to take out those stop losses and stop buy stops and sell stops to accumulate their big orders to then enter their position. In another video, I'll explain more in depth in that, how you can use that to your advantage in your setups. But that's why these market makers do that. That's why the market seeks those stop losses. So, sorry, I got a little sidetracked, but I had to explain that to you guys. So, yet again, look, you see price dump down. Retail traders are like, oh yeah, okay, price is dumping off. We have to jump in. You know, they sell, set their stop loss above here, go for a crazy try to go for a crazy profit. And let's see what price does. And look at that. It's manipulation at its finest. The sellers just got stopped out and just lost a lot of money. So you got to remember that whenever you're trading, just remember or keep in mind and ask yourself, who is in control right now? Are the buyer or what is the market trying to do? Did we just have a big sell-off and the market's trying to take out buy stops? Or are we in a big bullish order flow? And is there a bunch of sell stops below? You got to ask yourself that before, obviously, in your top-down analysis. You know, it's a huge confluence in it. Whenever you start implementing these ideas into your trading, it will definitely take it up to the next level. I promise you that. Liquidity is the main foundation. It is the foundation of ICT concepts. Liquidity. Where is the liquidity at? Where is the most liquidity at? And what liquidity is most likely to be taken out by price? Yeah. And that's where the work comes in. Taking it out, or putting in the work, trying to see signatures in price that make you decide what liquidity is most likely to get taken out. What is it in your favor? You know, is the probability in your favor with that bias? So I hope you guys really found some education in this video. I really hope I tried my best to explain it well. I really hope you guys found simplicity in this video. That's why I try my best in all my videos to be just simple, real with you guys. And I just try to make it simple as possible for the new guys, especially because I was once there and I was needing someone to explain it simply for me, instead of all these big words and blah blah blah, whatever. But yeah, I hope you guys found it helpful. I want you guys to go test this out, back test it in the market, look for it for yourselves. Get to train your eye on it so you can naturally see it over time in the markets. And I really hope you guys stick with this, and I'm talking to all the ICT beginners out there. I really hope you guys stick with this because it's really life changing and game changing if you can really truly understand it. So if you guys can do me a favor, if you guys did enjoy the video and you guys do want more, please make sure to drop a like, drop a sub, drop a comment, please. And yeah, let me know how I did. Any more notifications, I'll make sure notifications are on too. I'm gonna try to be uploading more. And yeah, just let me know what other videos you guys want in the comments, and I'll try my best to get to it. Alright, you guys have a good rest of your day, and I will see you guys in the next video. Peace.